Ever felt that gut punch when a loan application gets denied? Or you're stuck with sky-high interest rates, all because of some mysterious credit score? It feels like this number controls your financial life, yet most people barely understand it. For years, credit scores have been this opaque, confusing barrier between you and your financial goals. But today, we're pulling back the curtain to demystify it completely. We'll break down what your credit score is, why it matters, and most importantly, simple, actionable steps to build and maintain an excellent score. Get ready to take control of your financial future. At its core, your credit score is a 3-digit number, usually ranging from 300 to 850, that represents your creditworthiness. It's essentially a report card on how well you manage borrowed money. While there are various scoring models, FICO and VantageScore are the most common. Lenders use these scores to quickly assess the risk of lending you money. A good credit score can mean the difference between getting approved for a mortgage or car loan or being denied. It directly impacts your access to major financial opportunities. Beyond approval, your score dramatically affects the interest rates you'll pay. A higher score typically unlocks lower rates, saving you thousands over the life of a loan. It's not just about loans. Landlords check credit, some insurance companies use it to set premiums, and even certain employers review your credit history. So how is this crucial number actually calculated? There are 5 main factors that contribute to your credit score, each with a different weight. Let's break them down. The biggest piece of the pie, accounting for 35% of your score, is your payment history. This is simply whether you pay your bills on time, every time. Late payments, especially those 30 days or more past due, can severely damage your score. Consistency here is paramount for a strong credit profile. Next up, at 30% of your score, is amounts owed, or credit utilization. This measures how much of your available credit you're actually using. Lenders prefer to see low utilization, ideally below 30% of your total credit limit. High utilization signals you might be over-reliant on credit. Your credit history length makes up 15% of your score. Lenders like to see a long track record of responsible credit use as it reduces their perceived risk. This is why closing old, paid-off accounts can sometimes hurt your score, as it shortens your average account age. Keep those old accounts open if possible. New credit, accounting for 10%, looks at how many new accounts you've opened recently. A sudden flurry of new applications can make you look risky. Each hard inquiry for new credit can slightly ding your score. Be selective. Only apply for credit you truly need and space out applications. Finally, credit mix, also 10%, considers the different types of credit you have. Installment loans like mortgages and revolving credit like credit cards. A healthy mix shows you can manage various credit types. However, don't open accounts just for diversity. Focus on the other, more impactful factors first. Now for the practical steps. First, and most crucial, pay all your bills on time, every single time. Set up automatic payments to avoid any missed deadlines. Second, keep your credit utilization low. Aim for under 30% on each card, and ideally across all your cards combined. Pay down balances often, not just once a month. Third, resist the urge to close old credit accounts, especially if they have a good payment history. These accounts bolster your credit history length. Fourth, be strategic about new credit. Only apply for what you truly need and avoid opening too many accounts in a short period. Each inquiry has a small, temporary impact. Fifth, regularly check your credit report for errors. You can get a free report from each of the 3 major bureaus once a year at annualcreditreport.com. If you find an error, dispute it immediately. Incorrect information can unfairly drag down your score, so vigilance here is key to protecting your financial health. For those with little to no credit history, start with a secured credit card or become an authorized user on a trusted family member's account. This builds your payment history. Building excellent credit is a marathon, not a sprint. Consistency and discipline over time will yield the best results. There are no shortcuts, just smart habits. By following these simple steps, you'll open doors to better interest rates, easier loan approvals, and significant savings throughout your financial journey. Your credit score isn't a mysterious, unchangeable fate. It's a reflection of your financial habits, and you have the power to shape it. Start today and watch your opportunities grow. If you found this guide helpful, hit that subscribe button for more practical, no-hype financial advice from Wealth Labor. We're here to help you build your wealth, one smart decision at a time.